Hello, I'm Natalie MacDonald and you're joining me for Sydney Direct with Dukascopy TV. This week I'm reporting from Melbourne, Australia and caught up with Julie Toth, Chief Economist at the AI Group ahead of next week's RBA meeting to find out her expectations for monetary policy and also to discuss whether or not that high Aussie dollar is impacting business investment. Julie, thank you so much for taking the time to chat to Dukascopy TV today. Much appreciated.
You're welcome, Natalie.
Okay, so let's talk RBA then. And the central bank has acknowledged that businesses aren't taking advantage of those record low interest rates and taking advantage and investing and having a go, as it were. Why is this? And is it really affirmation of comments that Glenn Stevens made recently that the Australian economy may in fact be at its limits of monetary policy?
It's a really good question. We've actually seen very weak levels of business investment in Australia in the non-mining areas, that is the areas of the economy, services, manufacturing, utilities, construction, transport. All of those areas really haven't been investing like they normally would, but that's been the case for some years now. I think there's a global element to this in that, globally we have seen weak investment levels, weak confidence levels that's really persisted since the GFC globally. We've certainly seen that in Australia. There's also some local elements going on as well. And as Glenn Stevens noted, it didn't matter too much when the mining industry was investing so heavily. We actually needed the rest of the economy to make some room for that. But now that that investment peak is coming off, the RBA and everyone else would like to see business investment pick up more generally, and that really hasn't been happening. The cash rate is already at a record low, but it's really not the cash rate, the cost of credit, that is of concern to business and that is holding them back from making those investments. Part of the problem is the outlook. We're not seeing demand picking up locally, and possibilities for increasing exports are pretty much limited to the Asian region. So for the businesses that are already engaged there, we are seeing quite good growth now that the dollar's fallen again. So for that group, there is the possibility of increasing their capacity, increasing their investment. However, for the majority of Australian businesses who are still very much focused on the domestic economy, they're not really seeing any reason to invest. So even though the cash rate's low, they're also seeing low returns out there and low probability of growth. So not so much the cash rate that's holding them back.
How then does this shape your guidance on RBA action for example, next week's upcoming meeting and also into the longer term?
Well, to the extent that the cash rate affects investment directly, I wouldn't expect the RBA to be looking to make cuts in order to stimulate investment. But indirectly, of course, the other major channel for the RBA moving the cash rate and affecting how business operates is through the currency. The cash rate does play a major role in the level of the Australian dollar. We know the dollar is still relatively higher than the RBA would like, and definitely higher than most exporting businesses would like. So if a cut to the cash rate can help bring the dollar down a little bit more, then it would be worth doing.
We mentioned already mining, export businesses. Is there more that the government could be doing to ease that transition that we're attempting to see into non-mining investment?
Yeah, well, any actions that will help push the dollar lower at the moment are certainly very welcome. We're already seeing quite a good bounce up in the export index within our performance of manufacturing index, for example. So we know that the lower dollar is already helping some groups. We know also in areas like construction, for example, that import replacement is going on, so businesses are switching back to locally made goods in that area, so it is helping. Services as well, we've seen a pickup already in international student numbers, and to a certain degree retail spending at the local level is looking a little bit stronger. So all of those things are looking promising, but certainly very weak signals at the moment. On the policy side, there's the monetary policy. There's only so much that the RBA can do with the cash rate. It is already at record low levels. However, outside the RBA, we've got the rest of government. We've got the federal government, we've got Treasury, we've got the industry departments, and we have the state departments and the state governments. All of those can and should play a part in helping to foster a more positive environment for those non-mining businesses to flourish, whether that's through direct spending, things like infrastructure investment, looking at which major projects should possibly be pushed forward. The New South Wales government, for example, are using their budget surplus to push ahead with some very major infrastructure projects which will help boost growth rates in Sydney. Outside Sydney, we probably need to see more in that vein.
In terms of the Aussie dollar, I mean, this has been a long-running issue, and I have no doubt that Glenn Stevens at some point in next week's sort of charade will again jawbone that, or attempt to jawbone that Aussie dollar lower. But is the currency levels really hampering investment, or have businesses really gotten used almost to not pricing in that historically high currency to their strategies?
Well, we had that 3-year period where the dollar was over parity against the US dollar, and that did cause problems because it went on for a lot longer than most business planners and strategists were planning for. You could almost see a grieving process going on there. The first year of it was, oh, this can't last. The second year was more of an acceptance and getting used to it. And by the third year, businesses were planning around having the dollar at those levels. Now that it's fallen, that sort of almost happened in reverse, in that it's taken a little while for businesses to accept that the dollar looks like staying lower for longer. But we're all very, very aware of the risk of it moving higher again. For example, if things don't pan out in the US, if things go pear-shaped in the Eurozone, there's lots of reasons why external to Australia our dollar could be pushed higher again. So that is still a significant risk. Where it's trading at the moment, we think most businesses would be comfortable with rates under 80 cents as a trading range, but certainly the long-term average is closer to 75 cents, and they would be happier and more comfortable if it was down there again.
Julie, thank you so much for your time today. We look forward to catching up with you again in the near future. Thank you.
Thank you, Natalie.
Many thanks there to Julie Toth, Chief Economist at the AI Group. That's all we've got time for right now, but I will be back with plenty more exclusive interviews for you right here from the heart of the APAC region. For now though, it's goodbye.